Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the On24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. Our poll questions will appear in the slide area. Be sure to click directly on the slide to answer poll questions throughout the webinar. You can resize these widgets for a larger or smaller view. You may also follow along with a PDF version of the slides that can be found in the Related Content widget. The CPE criteria section details the requirements you must meet to receive full credit for CPE in this session. To obtain CPE, you must do two things. First, be on the live webinar for the specified length of time, and second, respond to the required amount of poll questions that will appear throughout the session. You can find the specific time and poll requirements and also track your viewing progress in the Earn CPE widget on your screen throughout the webinar. By registering for today's event, you will automatically receive an email after 24 hours that will have a link to download the slides and a link to view the recording. Additionally, if you meet all the criteria and qualify for CPE, a link to your CPE certificate will be sent via email. Please remember that it does take 24 hours for that email to be automatically generated, so look for it sometime tomorrow afternoon. For CPE-related questions, please reach out to cpe@yptc.com. Moving along, in the Related Content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Using the Reaction button, you can react to content throughout the webinar. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the Speaker Bio section, you can find out more about our presenters, including their contact information. If you need technical assistance, please use the Help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the Evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
Hello and welcome to More Than Admin, How Overhead Powers Your Mission. Whether you're joining us from a finance team, development office, or executive leadership, this session is for you. Overhead, it's one of the most misunderstood and often misrepresented aspects of nonprofit operations. But today, we're really hoping to bring some light to this very powerful concept. Before we get into today's session, I'd love to introduce who we and YPTC are. Your Part-Time Controller is a professional services firm that specializes in nonprofit financial management with over 30 years of nonprofit expertise. Our services include accounting, reporting, data viz, and best practices, just to name a few. Our network of almost 800 staff have seen it all, helping over 2,000 clients throughout the United States, as well as clients in several other countries. My name is Carly McIntyre, and I will be moderating today's session. I'm part of the training department here at YPTC, where I get to do one of my favorite things, which is collaborate with our experts around the country to bring you relevant and hopefully inspiring content. So whether this is your first time joining us or a familiar face in our virtual crowd, hello again. We're very grateful to have you with us today, and I'm pleased to have our esteemed panel introduce themselves. So Greg, I can pass it over to you to share a little bit about yourself. And Greg, I'm not able to hear you.
How about that?
Yes. Hello.
Oh, right. Yeah. Hello. I told you my whole life story. I don't want to repeat it. No, I started at YPTC back in 2011 in our Philadelphia office, and we launched our Central New Jersey office in 2019, and I am the market leader for our Central New Jersey office. It's been a great 14 plus years here at YPTC, and the growth has been exciting and amazing. So why this topic is important to me is that, so our mission at YPTC is to help nonprofits, and helping them understand the vital role that overhead plays is a key component of their success. And maybe even more importantly, delivering this message to stakeholders, boards, funders in the nonprofit community everywhere will hopefully bring a change to this mindset that overhead is bad.
Thank you. And Sandra? Sandra, I'm not able to hear you either, actually.
Okay, let's give it
Now
a
I can hear
second.
you.
All right, there we
with each
go.
other again.
Sometimes, well, anyways, my name is Sandra Magri, and I am the director and market leader of YPTC in the Boston area. In the Boston market, we serve all 6 New England states. I've been with YPTC for 4 years, and this topic is really important because I think it's confusing. I think giving the information in an easily digestible format will help people understand exactly what that means, and use the tools that we hopefully give them to impact their mission and their stakeholders a little bit clearer.
Thank you. And finally, Eric.
Hi, everyone. My name is Eric Wilson. I am the director of our Dallas, Fort Worth, North Texas office here at your part-time controller. I've been here for about 7.5 years at this point. Originally started in Houston and then moved further north to launch our DFW office a couple of years ago. And why this matters to me is, I think, Carly, you said it best, there's misunderstandings and misrepresentations on this topic. So one side of it is how the public at large understands and interprets this information, but a big part of it too is how we as members of the nonprofit community are putting our own information out there and sharing and maybe doing a little bit of proactive education on the story behind the work that we're doing, not just programmatically, but how that reflects in the financial statements as well.
Amazing. Thank you. And thank you all for being here and being willing to contribute your voice and your expertise. So just for your information, we do have the slide deck available for download, and you can find that in the related content widget. Know that we also have the ability to have closed captions, and you can turn that on in the bottom right hand of your media player where you see the speakers. So today is all about clarifying what overhead really is, how it's allocated, and most importantly, why it matters. So together with the experts that you just met, we'll break down the components of functional expenses, real-world cost allocation practices, and then finally how overhead impacts external perceptions. So just as the experts kind of touched on, is we're really moving behind the myth and then into the mindset that overhead isn't just admin, it's absolutely mission critical infrastructure. And that when understood and communicated clearly, overhead becomes a strategic asset. So let's kind of dive in here and reframe the conversation. But first, we will have our initial poll questions. And since this is a longer session, it is 90 minutes long, we will have 6 total polling questions. So please respond to your poll question. Go ahead and click directly on the slide area where the poll question has appeared. And we would love to hear what you think about when you hear the word overhead. What's your first reaction? Is it a necessary part of running an organization? Or is it inefficiency and waste? Perhaps it's just something that funders don't like. Maybe it's a little bit of a combination of some of those. And are you here because you're looking to learn more? Are you just not sure where and what that really truly means? So as we are getting these responses in, I'm really excited to dive into the conversation with Greg and Sandra and Eric, because they will provide a lot of clarity around what this word actually means. The different terminology already in the chat. I'm seeing that the different perspectives on, or even just terminology used for this concept. So I'm going to go ahead and advance the slide. And it looks like many people, in fact, the majority of people think it's both a necessary part of running an organization and something that funders don't like, which I understand. And Greg, yeah, I mean, what I'm seeing you smiling. What do you think about that?
Well, hopefully we can change the mind of funders, and we'll talk a little bit about that. But sure. I guess let's start off with what overhead really is. And despite common misconceptions, overhead is not a bad word. It's actually a vital and powerful resource that undoubtedly necessary for any organization, whether you're a nonprofit or a for-profit. The most frustrating thing, I think, for me is that society doesn't question the overhead of a for-profit organization, a for-profit business. It's only the nonprofits that get this spotlight. So I think it's all of us in the nonprofit community, we need to set the tone that overhead is not the enemy. It's a powerful resource. So let's start off and sort of define overhead. And, I think overhead has been maybe defined, or if you ask different people what they think it is, they have a couple of different terms that they may use. Non-programmatic cost, fixed monthly cost, operational cost, administrative cost. I mean, they're all good ways to describe it. But I think the best definition is that overhead are the costs that support the organization as a whole, and specifically related to administrative and fundraising costs. And we have to keep in mind that overhead is needed and necessary, not only for organizations to sustain their operations, but to grow. And I think, what we see is that nonprofits are unfairly judged by the amount of their overhead. But we have to think that we have to let people know that there are other factors that should be considered to measure how effective an organization is. So when we're calculating overhead, a term that is often mentioned is the overhead ratio, and that's used to express the level of overhead that any particular organization has. And it calculates the percentage of support services to all the costs of the organization. And how do we do that? Well, think about the audited financial statements of an organization or their Form 990. In both of these resources, there's a schedule of functional expenses. And what this really shows is what the organization is spending money on and why they're spending that money. So organizations, they report expenses by what we call the natural classification of an expense, like payroll or rent or telephone or supplies. In these reports, these often represent the rows in that report. But organizations, nonprofits also report by function. And there's 3 major functions: program services, management in general, and fundraising. And again, in those reports, that represents the columns. Support services are the combination of the general and management in general and the fundraising together. And that percentage to the total cost represents our overhead ratio. So let's look at an example. Here we see an organization has total expenses of $1 million. And if we look to see our management and general expenses are $150,000 and our fundraising expenses are $50,000. So our total support services are $200,000 over that $1 million of expenses. So our overhead ratio is 20%. Now, I want to sort of reiterate the point that I started off with. The natural classification of an expense does not determine if it's overhead. So salaries, rent, utilities, supplies may be considered direct or indirect program costs. And if they are that, then they are not overhead. Properly reporting costs to the appropriate function is the key to getting this correct. Now, the overhead ratio could be unintentionally or even intentionally manipulated. And to sort of address this, Sandra is going to be focusing on cost allocation in the next section. We have the opportunity to tell the story of our organization to donors, potential donors, stakeholders, board members. They all want to see information and look to see what the overhead is for a nonprofit. But we need to get them to understand that overhead is not just a number, it's really a story. It's a story about how an organization operates effectively. And they're going to be looking at resources like the audited financial statements. There's a statement of functional expenses in there. They're going to look at Form 990. There's a schedule of functional expenses in there. They may also look at the organization's own annual report. Oftentimes we see organizations that produce an annual report. They may have some kind of a pie chart on what their functional expense spending was. That's very simplified approach to it. And I think there's an opportunity to even enhance that by adding a narrative, not just the numbers. The numbers are going to distract people from or limit people to understand how effective the organization was. But when we can put a narrative in there, it gives the organization a better opportunity to tell its story. So we want to be proactive. All these, our 990, our audited financial statements, our annual reports, it's great to publish those on your website. Have them be a tool to educate your donors or potential donors about the organization. Now, we always hear about transparency and being compliant with whatever organization or regulations we have to deal with. But I don't want people just to think about transparency as being compliant. I want them to think that transparency is going to build trust. And when we have that trust, we're able to deliver our message much more effectively.
Amazing. Thank you for that introduction, Greg. And during this conversation today, obviously, we're going to go through and explain a lot of these concepts and provide real life examples. But I really want to leverage the combined decades of expertise and experience that we have on our panel today. So we'll be interspersing some discussion points and really talking through some of these common questions. So Greg, you're just kind of speaking to transparency and being able to provide trust and build that trust. And a lot of times where the finance teams are working with people who are just purely passionate program related people, right? They see the mission and the impact and might not have the background of the accounting knowledge. So how do you all explain functional expenses and these concepts to non-financial stakeholders?
Yeah, so functional reporting, again, is giving the why. Everyone's familiar with what type of an expense things are. Salaries, obviously, that's people getting paid. But why are they getting paid? What are they getting paid for? And our functional expenses get to tell that and put those in those three major categories. So it provides the why to the what.
Sandra, I'm not able to hear you.
Mm-hmm. Muted.
Mm-hmm.
It might take a
Not
second.
Oh, here we are.
Okay, sometimes my microphone decides it just needs a second to wake up. So maybe it's because, I don't know. Anyways, so whenever I'm talking about functional expenses to non-financial folks, I like to think about it as different buckets, and it's a grid system, right? So if you're looking at your natural classifications for salaries or whatever, and then you have your different buckets of functional expenses, it helps visualize things in at least a different way with the different rows and columns to really show you where your salaries are going or where your other expenses are going. I think that visual sometimes really helps folks.
Mm.
Yeah, and I'd agree with a visual example. I mean, like Greg said, this shows up on your audit and or your 990. So if you don't want to have to make your own example, you can just pull your most recent 990, and it's one page that is the statement of functional expenses. It's still an IRS document, so it's going to be scary for some people to look at, but it does visually show, here's what I'm talking about when I do these things, right? And the line items that we break out versus those columns. And that also kind of supports this. Why do we have to do this? It's like, well, it's mandatory. It goes into this form, and here's, you know, some of the constraints that we're bound to and how this reports out. And so we need to track things internally to make this an efficient and effective reporting process at the end of the year for that audit and or 990.
I really appreciate that. I'm sometimes a visual learner myself, so seeing it like that is a very helpful tool. But to your point, Eric, is it really, it's like data in is what you get out as well. So the key to being able to report this and report the different functional classes is really through this reasonable and consistent allocation of expenses, cost allocations, right? So Sandra, I'll pass it over to you to take us through this concept.
Thanks. Can you hear me? Great, my microphone's cooperating. So let's talk about cost allocations and what does that mean. So in this section, I'm going to talk about the whys of cost allocations, right? Why do you have to do this? We're going to talk about them being required. We're going to talk about the practical application of the allocations and the importance of documenting, along with, at the end, I'm going to show you an example of a written cost allocation policy. So again, that visual, I think, is really, really important. All right, so let's get into it. So what is a cost allocation? Well, in simple terms, a cost allocation is, okay, there we go. Cost allocation is the process of spreading shared expenses across activity centers, departments, or programs. So for nonprofits, this means spreading your costs not only by the functional categories of program, general, and management and fundraising, which these are required, by the way, but also it shows down at that next level, which could be by departments or programs or activity centers. Activity centers are the service activities that an organization derives their revenue from. So when we talk about costs, are costs that are just what they sound like. They're directly identifiable to a specific program or activity, while indirect costs are not as obvious. They're not as clear, right? They can't be, the costs incurred benefit more than one objective, more than one program, or more than one activity, and they cannot be readily identified to just one thing. Indirect costs, so you'll allocate those costs, and anything that isn't allocated to the program function will fall over into that overhead bucket that Greg was talking about. It's important to keep in your brains as we're thinking about this, that indirect costs and overhead costs are not the same thing, right? So keeping that clear, I think, will be important as you work through some of these allocations and some of these concepts. Nonprofit organizations really do need to have a cost allocation policy that's documented. These policies talk about how you're allocating your costs. And like I said a few seconds ago, we're going to see an actual policy so you can see what that language looks like. So you talked about the what, now the why. Why do we have to do this? Well, first of all, they're required, right? So GAAP requires it. Generally accepted accounting principles says you have to do that. The IRS also requires it. The 990 says that all tax-exempt entities, all public charities, including 501c4s, right? So social organizations, social welfare groups, civic leagues, you have to do this. You have to report your expenses by their natural classification and their functional. And in order to do that, you have to have cost allocations. Additionally, some funders also require this. If you're getting federal dollars, they require that you have a cost policy documented. And whenever I say federal dollars, people automatically think about a NICRA. If you're going there, we're not going to talk about that here, so don't get excited or dread. But if you're interested, we have a webinar on our website from April, and it's spring into stability. So that's out there. We could spend a whole day talking about it. We're not going to get into that here. So anyways, so you have to have that policy. And outside of that, you really can't perform adequate business analysis and have that data to effectively run your organization. So let's talk about the guidance, because we have a poll question. My mistake, I was getting ahead of myself.
We want to put the participants' knowledge to the test here and see if they're paying attention to what you're saying, Sandra. And here is our second poll question, our second out of 6 poll questions. So which of the following expenses is least likely to be classified as an overhead or to management and general cost? Is it your executive director's salary? Is it program supplies, perhaps accounting services, or office rent? And there is a correct answer to this one, isn't there, Sandra?
There sure is, but we won't judge you if you get it wrong. It's part of the learning process, right?
Absolutely, absolutely. All right, we'll give just a few more seconds here. And again, click directly on your screen and press submit to answer the poll question. And then you'll need 5 out of a total 6 questions today, responses today to earn CPE. All right, so we're gonna see how you all did here. And the majority of people did get it correctly. You're not going to, traditionally at least, allocate any program supply expenses to overhead because it's a programmatic expense. Sandra, I'll pass it back to you.
Thanks, nicely done, everybody. All right, so now that we had some fun with that, let's go into our guidance. So what does GAAP say? This comes from our accounting standards codification. For all of you GAAP nerds, it's 958-720-45. And what it says is to help your donors, creditors, and others in assessing a nonprofit service efforts, including the cost of its service and how it uses its resources, a statement of activities or notes to the financial statements shall provide information about expenses reported by their functional expense classification, such as major classes of program services and supporting activities. So GAAP is pretty clear on what we have to do, which again, why it's important. So let's go into the IRS guidance because that's equally as important. The IRS defines program services as activities that further an organization's exempt purpose. So that's cost to secure a contract, to conduct research, produce an item, or perform a program service. Unrelated trade or business activities, regardless of the tax implication of that, that goes into your program service. So don't think just because it is a different category, it doesn't go, it goes there. The IRS define fundraising as expenses incurred in soliciting cash and non-cash contributions, gifts, and grants. That includes costs to solicit grants to provide services to the general public. The IRS really only provides guidance on programmatic and fundraising costs. So if costs don't fall into one of those 2 categories, then they will automatically go into the management and general bucket. It's also important to note that the IRS has adopted the guidelines set up by the AICPA for allocating costs. And the requirement is that cost allocation is consistent and reasonable. So that's another really important reason to have a written cost policy, because it will show the IRS that your classifications and your methodology are reasonable. Okay, so now we're done with that. Let's talk about the importance of allocating costs from a business management perspective. So in order to effectively run your business, right, you need to be allocating your costs. So we all know that not every program that you run will make a profit. We know that. That's the crux of nonprofit organizations, right? So that's why we have to fundraise. In order to have the data points to make those decisions, you have to have your costs allocated, right? You want to be able to evaluate the true costs of your operating programs or how much it's costing to provide services. When you look at that grid, you're going to say, and you might see, oh, program A, and program A is profitable. So let's put more resources there because maybe we can have more impact there. Or program A is having a really big impact, but it's not making any dollars. Maybe we should fundraise more. So having that grid system, I think, will be really helpful to get you that data. Okay, so how do we allocate costs? Well, most, outside of the fact that we have to do that, right? So we don't want to sleep on that. We have to do this. But how do we do this? So most nonprofit organizations, 85% of your expenses are going to be payroll or facility related. So we're going to talk about those first because they're the most common. So costs can be allocated on many different ways, and management should select the method that best fit the expense type. So percentage of time and effort, right? Having your time and effort tracked. So this is the most common way to track your costs, and that will be your salaries, your tax and benefits, or anything of the like. You might be wondering, how could I track this? How could I capture this data? Well, I'm going to pop on a soapbox for just a second and talk about how important timesheets are. If you've ever met me, if you've ever spoken to me, if you've ever spoken to anybody at YPTC, we're always going to say, put in a time and attendance system, because it is the most effective way to measure time and effort, and it will save you a lot of headaches down the road. I'll get off my soapbox. So another way is FTEs. So you can use FTEs to allocate, and that will be taking the number of bodies that are employed regardless of their salary. And you can allocate costs such as telephone or office or other types of supplies that might make sense for that. Another way is square footage. So square footage estimates the part of the building that's used for rent, utilities, repairs, and maintenance. So you can use that percentage of portions of that cost or that space and allocate costs accordingly. There are other methods outside of these, and they are direct costs. So direct costs they're obvious, right? They're the ones that are directly attributable, like we talked about earlier. And then you can use KPIs. So KPIs are any indicator or any metric that you use to run your business, to indicate success or to track things. So these data points are relative to your organization, your specific industry, and your key indicators could be a number of students or clients served or meal served or beds housed or whatever a metric is for you. Important to know that regardless of how you do this, your management judgment comes into play. That's an important thing to identify how and what methodology to use. So now let's talk about the practical applications for these. So we've talked about the grid and how important that is to visualize it. But what do you do with that? Now that you've allocated all your costs, you have your grid laid out, you want to look at it and say, okay, maybe program A is showing that you, again, you don't have your break-even point, or you haven't reached your break-even point, but now you have that data in that calculation, so you can figure out your pricing. You've also now captured all of your true program costs. So when you're claiming reimbursement, if you have reimbursable type grants, you can have that data to make that submission process a lot easier. So it'll also be helpful to strengthen your grant applications, because funders want to know that you have your ducks in a row. They want to know that you have everything organized and you know where you're spending your dollars. Also, understanding where your staff are allocating their time will be really helpful, because you may have different, you may have people working places that maybe you're overstaffed, right? So you can move things around differently. And also, if you're looking at this statement of functional expenses and your allocations monthly, you can see trends and respond to them in real time, because you have that information ahead of you, which can also help you figure out ways to grow or areas to divert resources and move your attention.
All right, so Sandra has done an amazing job talking us through the what, the why, the how of cost allocations. And I'm really curious from your guys' perspectives, or what are common mistakes that you see organizations making when doing these allocations, and how can they potentially avoid them?
Yeah, that's a good one. I would say not documenting their methodology, right? That feels like the most important one.
So as I'm looking through some of the Q&A, I see lots of questions related to this, and I just want to warn people: don't fire your accountants. They may be doing it right, not wrong. I chuckled when I saw that one, but it's how we're allocating. So specifically talking about staff, not allocating staff that are doing programmatic activities to the program function when they're typically a G&A type person, or allocating someone who's not doing programmatic work to programs because they really are a G&A type person. So again, it's not what type of expense, it's why. And as Sandra mentioned, allocating based on time and effort. Like a grant accountant, they're typically, maybe applying, or even the process of applying for a grant. That's not the programmatic activity. That's just working on getting the funding for the program. That is not going to be programmatic. That's going to be support services. But an executive director who's doing a lot of different things, when they are spending some of their time actually performing programmatic services, that portion of their time could be allocated to the programmatic function.
Yeah, and then I think I'd just say, there is a lot of complexity here, and we see that in the examples, we see it in the questions, we see it in the guidance. We want to be thoughtful in how we're doing this, but we don't have to overcomplicate it or go too far off the deep end, right? So we talked through, there's a bunch of different methodologies. We can use headcount, we can use square foot, we can use time and effort, we can use participant counts from programs, and then how we slice and dice things, and we can get really sophisticated. But we don't want to go too far in that direction and make this overcomplicated or even convoluted, right? So have that documentation, but let's be thoughtful about this. If our approach makes sense, it's reasonable, we've got an outline for that that's documented, and we follow it consistently every time, we're good. And so we can keep that in perspective in mind and be pragmatic when we craft this process, especially because the catch-22 here is the time, the money that you spend on crafting this calculation and doing it every month or quarter or year, that is overhead too. So we want to balance the administrative burden that we put on ourselves to get accurate information, reliable information, consistent year to year, but balance that against, is the juice worth the squeeze on how we're putting this information together.
Especially when I'm sure there's a million different priorities that the participants listening to this are experiencing. And this is just another thing, but I love that, Eric, is no need to overcomplicate it. And just to respond to a few questions that I'm seeing is to reiterate what Eric just said is, yes, it is okay to use a combination of methods. It's just making sure that they're reasonable and consistent and documented, to Sandra's main point as well. So also here are some pieces of that. And thank you so much for all of the amazing questions that are coming through. We're really going to do our best to get to those either during the polls, or hopefully we'll have some time at the end, but we'll move forward here.
Support services, right? We talked about program allocations, we talked about direct versus indirect. So what is support service? And Greg did a really good job teeing me up during the panel, so thanks for that, Greg. So management in general, what does that mean? Well, management in general are costs related to the administration of all the functions, and they're reported as management in general activities because they represent a supporting activity of the organization. So like Greg said, expenses of support staff, example, your executive director, those costs are considered management in general. However, if these folks are spending any portion of their time directly conducting or supervising programmatic work, their costs could be allocated among those functions to the programmatic areas. On the other hand, grant accounting and reporting are not part of the direct conduct or supervision of a program. And those costs are considered an accounting function and should not be allocated as program activities. And this will apply to the compensation, benefits, anything related to those folks. So moving on from management in general, we talk about fundraising and membership development. So if an organization receives contributed revenue, most nonprofits do, unless you're all fee for service, they most likely have incurred fundraising expenses, and those costs should be allocated as such. So any activities that include applying for grants and soliciting contributions are fundraising activities. Nonprofits, important to note, nonprofits often conduct activities that mix program activities and fundraising, and these are referred to as joint costs. You'll see it on the screen that if your joint costs don't meet the criteria of purpose, audience, and content, then they should be reported as fundraising costs. When we talk about membership development, it's similar. So if you're an organization that does memberships, or you're soliciting memberships that are contribution, the same concepts apply. Any expense or any activity you're doing should be attributed to membership development. Any cost that doesn't end up being allocated will land in your general bucket, right? When you think about that grid, you've allocated everything, then you have this other column of what do I do with this? Well, that's all going to go to management in general. All right, so I promised there would be an example of what the cost allocation policy looks like. We generated this with our handy dandy AI tool. And this is a fictional organization, and it's disclosing the costs of program and support service activities. And it's been summarized, and it's saying it's been summarized on a functional basis, and expenses are presented by their natural classification and by function. The policy states that certain costs have been allocated among programs and supporting services, as certain categories of expenses are attributed to more than one program or supporting function. This disclosure tells us how that allocation is done on a reasonable basis and that it's consistently applied. I thought I saw some questions in the chat around how to document and how to talk about different expenses. And this talks about that, right? This talks about how expenses for occupancy, depreciation, and amortization are allocated on a square footage basis, whereas expenses for personnel, so salaries, benefits, payroll taxes, and then expenses for professional services, as well as office expenses, IT, interest, insurance, and the like, are allocated based on time and effort. I'm going to get my soapbox back out and say, when we're measuring time and effort for personnel costs, make sure you're using timesheets. That even goes for your salaried staff. You should be tracking that all the time because it will make that allocation process significantly easier. Now I'll kick it over to Greg, and he will walk us through a case study that will help illustrate some of these concepts.
Yes, thanks. So I think talking about looking at something, I think brings it all home. And this is a little case study that I like to refer to as addition by subtraction. Doesn't always work. And it really demonstrates the power of cost allocation from a management standpoint. So not required for, we're not doing this for audit. We're not doing this for the IRS. We're doing this to help us run our organization better. So here we have a short version of an organization's budget. And I always preach to my clients, they should be budgeting for a surplus. But we see here this organization actually has a deficit, a budgeted deficit of $30,000. And, we want to see why that is. When we look at this type of a format, we can't get any answers why there is a deficit and what we can do to maybe change that. So let's change the way that we present this budget. And in doing so, if we present it showing our programs and showing our support services and allocate the cost accordingly on a budgetary purpose, this will help us get a clearer picture on why there is a loss. This is vital for decision-making purposes. Now, if I just glance through here real quickly, look at that, I found our culprit. Program C is reflecting a $33,700 loss. And of course, management wants to see what will happen if we reduce this or get rid of this loser program. That should hopefully make our budget in balance now, maybe even just doing simple math, maybe we'll have a surplus of $3,700. Well, let's see what happens. Well, unfortunately, our deficit did not go away. We still have a little bit of a deficit, and we removed the Program C. We removed the direct costs of Program C. Obviously, we got rid of the revenue Program C if we're not going to do it. But what remains is our indirect costs that were allocated to Program C. And these costs won't go away just by getting rid of the program. They're either going to have to be picked up by a different program or effectively be a part of our overhead. If we didn't allocate our costs and present our report this way, we would never see that and never realize that getting rid of Program C, although it would reduce our deficit, it wouldn't make it go away completely.
All right, which brings us to our next polling question. How does your organization currently talk about overhead with funders or the public? So in our next section, we're really going to get into the narrative around this and just telling by the amount of questions that are coming in and the different perspectives of Greg and Sandra and Eric. Obviously, this is kind of all over the board. And so let's see if we can kind of clarify something as well, just from some of these questions. We're getting a lot of questions about the allocation of salaried employees. And so can someone please talk us through how that looks? So say they're spending, half of their time on program, maybe 30% of their time on management, and these times can change over time as well. Can you guys talk us through the application of those percentages?
Yeah, and just the fact that you said 50% of the time relates to programmatic work. Well, there's the allocation, and 50% simple math there. I didn't have to use my fingers. The other 50% is going to be support services. That's overhead. And as Sandra said multiple times, we can develop that or calculate that by their timesheets, by time and effort, how much time they spend on the programmatic work compared to all of their time. And then we can apply all the costs related to them as an employee, their taxes, their benefits, whatever else is related to them as an employee, at that same percentage.
Well, thank you, Greg. I'm going to go ahead and advance. And I'm pleasantly surprised to see that most people are actively explaining and justifying it. However, there is almost half of us, the other half of people, not talking about it at all, or just simply not sure. And so hopefully by the end of this conversation, you'll get some clarity around that. But just to segue us into the next conversation, is where we're really getting a lot of questions about what's the correct rate, or what's the recommended rate for this expense or that expense. And so Eric, can you kind of talk us through what is there a correct rate? Can you, and what does this mean to different stakeholders as well?
Yeah, I mean, this starts with my favorite 2-word answer to any question is, it depends. But really, there's no one right answer for an overhead rate. This has come up in the Q&A, and I think we've touched on this in our conversation too. It's just there's so much variability in how these allocation processes are done, and what that looks like from one organization to the next, or even based on accounting rules, what does and doesn't show up in your financial statements, and how does that affect your business model versus your financials for something like a lot of volunteer activity, right? That doesn't necessarily turn into numbers on your financial statements. So it's really hard to just say, this is the number. Maybe the closest thing I could point to, and we'll get to this a little bit further in the slides, but when you're looking at we'll talk a little bit more about some watchdogs, charity organizations, and their rating nonprofits. I think the general benchmark tends to be around 25% in some of those calculations, but the context behind that number is so important that to set it at just the number itself, it's missing critical information that goes alongside that. And with that, I think we might have another panel question before we move into reframing the narrative, talking about that context so much, but just to get past some of the myths and into the strategies. Carly, do you want to tee us up for our next panel question here?
Absolutely. Thank you, Eric. Into those myths, what is one myth about nonprofit finances that you wish we could retire forever?
Yeah, and I think I stole Greg's talking point for this, but maybe you want to speak a little bit more to the correct overhead percentage question.
Well, yeah, and Eric, you definitely teed it up that there isn't one, and people. I see some of the questions are, what should it be? How do we measure different organizations? I saw one of the questions that they look at some nonprofit 990s or audit financial statements, and the allocations don't seem plausible, and that could be the case. I think what's important is that if we can look at maybe like-kind organizations and see where that is, and then if you're in that group, compare yourself to those like-kind organizations, arts and culture, or a school, or a foundation, whatever it is. Also, I think within the life cycle of an organization, their overhead ratio will change over time. A newer organization might be more overhead bound because they're ramping up and they haven't maybe been full throttle with their programmatic work yet. And then the older, more mature an organization gets, that may balance out a little bit. Again, some of what we're trying to get across is let's stop worrying about the number and start thinking about, what we're doing as an organization. So this is an extreme example, but I always pose the question, if there was an organization that its mission is to end hunger, and they successfully end hunger, will people really care what their overhead ratio was at that point? And the way we present information can also distort the picture. So a great example is an organization that has pass-through activity. So they receive money and then they will re-grant that out or give that to other agencies to perform the work. Now, there's no right or wrong way to present this. Some organizations may deduct that pass-through amount from the revenues and expenses, and just mathematically speaking, that would create a larger overhead ratio than the organization that doesn't do that. They leave the money in revenue and they leave the cost in expenses. That's going to generate a lower or calculate to a lower overhead ratio. They're the exact same numbers. They didn't do anything different except for the way they presented their financial statements, yet we're going to get two different answers, and someone who doesn't understand that nuance is going to think one organization is better than the other. We have to wake up Sandra's mic.
Am I here yet?
There we are. Mm-hmm.
Here we are. It just falls asleep, and I'm not quite sure what that all means. But again, thank you all for your patience. So, as I was saying, there's no one-size-fits-all approach to these overhead ratios and to nonprofit finances, right? Overhead is subject to judgment, and I think Greg put it nicely, depending on the life cycle of the organization. If that critical infrastructure hasn't been laid yet and that overhead hasn't been deployed yet, then you might see that more in earlier years, and then it evens out later. It's also important to know that organizations may feel pressured to massage it to present it better, right? To Greg's point about the pass-through, some groups might do that because they want to make it look lower. It all goes to what your story is and how you're owning your numbers and what you're doing for your organization and for your mission.
Yeah, and then I think I'd tack on here, a real big myth specifically around overhead expenses. It's just the idea of 100% of your expenses or 100 cents of every dollar going directly to the program. I would say that's impractical at best, if not impossible. I think there's an inherent like paradox or catch-22 there, that you can't know how much of every dollar went to which programs if you aren't going through this process and doing accounting. And accounting is a management and general expense. So you can't access that information without some kind of cost, some kind of investment in the management and general function to measure that. But I do think there's a really important distinction to make, that just because these costs don't directly, they're not the direct conduct of a program, that doesn't mean they don't support the mission. And I think that's maybe what I would put on a sticky note, or like bring that, into every conversation, have that as kind of your talking point, because vendors have to get paid. Payroll has to be run. You have to file your Form 990 or the IRS gets very upset, right? So we can't not do these things, and that the mission, the program work is contingent upon these things happening. They're essential functions. And I think being able to speak confidently about that and bring that education to conversations can help as you maybe face pressures on overhead percentages, because it like we talked about, there's a lot of misunderstanding of what is and is not in that number. So that context is just so important.
So important, and really one of our intentions to clarify here as well. Go ahead, Greg.
Eric, that point you just made, that overhead is supporting the mission. It doesn't mean that it's a programmatic expense. We can't call it program, but we can't deliver the mission without overhead. We should say that out loud every time we're in a room full of people. Overhead is needed to fulfill the mission. Doesn't mean that it's programmatic cost. So what we have to do for regulatory purposes, for GAAP and for the IRS, that's one thing. But we're telling our story. Overhead is key to delivering our mission.
Yeah. And I think on these following slides, we're going to talk a lot more about how to tell that story, how to manage this communication. And a big part of communication is understanding your audience. And in this case, our audience is comprised of a pretty decent number of different stakeholders that might need to hear or are looking for different things or have different expectations of our organization, of our information. And so we want to adapt our messaging accordingly to meet them where they are, and speak to the lens through which they're viewing this information. So people like donors and the general public, they might not have this nuanced understanding of what overhead includes, right? They might have just a more emotional response both to your mission and to your spending, wanting to see more money go to the cause. And so managing that communication of, right, is this direct conduct of program versus support of the mission? Charity watchdogs, this has been one of many financial ratios that they've included in their evaluations as they kind of drive transparency in the nonprofit space. I think this helped popularize maybe the overhead ratio in some of these conversations, and that's changing, that's evolving. There's still including that in some of these measurements, but it really is the context behind that number that is so important, not just the number itself. Board members are interesting here because they may start a little resistant to overhead. They may have their own perceptions coming in, and this is an opportunity to have these candid, open, educational conversations with them, and then they could very well turn into a champion for your organization's overhead and understanding what goes into that and why it is important. So that's one that they could become someone that helps carry that message forward to conversations they're having about your organization with other stakeholders that they interact with. I touched on donors, especially like institutional donors. This might be information that goes into like a funding application, and it may look specifically at just a number, again, trying to include context where you can is so important. And then last on the slide is the media, right? And stories, whether that's bad press about narratives that are presented about spending and negative perceptions about overhead or misuse of funds. The stories that are out there, for better or worse, are going to shape public perception. So it really is just the more proactive that we are in this storytelling, the more ownership of it that we take confidently and standing true in that will go a long way. So with that, we'll talk a little bit more about charity watchdogs specifically, and just with a couple slides here. These are actually nonprofits themselves. They're out evaluating, monitoring the performance and transparency of charitable organizations. They're often nonprofits themselves with the mission of helping donors make informed choices about the organizations that they're going to support, while also encouraging accountability and effectiveness in the nonprofit sector. Most, not all, but most are issuing some kind of rating or evaluation based on information that they're gathering. Some, like GuideStar, which we'll talk about in a second, just allow an organization to share information about themselves to encourage kind of voluntary, intentional transparency. That information is then made available to the public. So it really is kind of, the intent is to encourage this transparency. Now, these evaluations, some of the metrics, the ratings, the scoring, often do include an analysis of overhead related costs. That could be the management in general as a percent of total. It could be how much fundraising revenue did you have for every dollar of fundraising cost. There's a handful of different financial metrics that are used by these watchdogs. We're only touching on a couple during the session today. But again, overhead tends to factor into these evaluations. And then these ratings that are issued ultimately matter because people are looking about them to form their opinions and inform their decisions about your organization. So donors, grant makers might be using this to decide where they're going to direct their funds. Volunteers or other nonprofits that are looking for partners in the space might look at watchdog information to benchmark similar organizations and consider where do they want to align their time and efforts, who do they want to partner with. Could be the same for a board member or even a future employee or a future leader of your organization, looking at what program accomplishments are you reporting? What does your financial health look like before they're committing to engaging with your organization and tying their name to it, either as a leader or a board member, since those are also reported on the 990. And with that, I think we've got another poll on the following slide.
We sure do. And we are curious. We're getting a lot of feedback in the chat about different challenges that people are experiencing or questions that they had. But what is your biggest challenge when communicating your organization's financial information to your stakeholders? We have here translating the complex data into clear and accessible language, right? Speaking to those different perspectives, maybe addressing misconceptions or skepticism, tailoring the message to different stakeholder needs and levels of financial literacy, perhaps even leveraging visuals, right? As we talked about earlier, some of us are more visual learners. So using those to support the financial narrative, and then maybe it's all of the above. But if you do have a challenge that isn't listed here, we'd love to hear what that is in the Q&A box. And while answers are coming in, I saw a few times in the Q&A back when we were discussing myths, the myth about budgeting for zero, right? Budgeting for a completely balanced budget. And that is just such an important concept that we've talked about a few times on our webinars here. But I really want to get your guys' perspective on that, before moving forward.
Yeah, I think the most concise way to put this, I don't know who originally came up with this, so I can't fully attribute the quote. It's not my own, but nonprofit is a tax status, not a business model. So budgeting for a surplus is pretty important, and that gives you flexibility financially, especially when there is uncertainty in funding streams, because then if you budget to break even, your contingent, your downside risk you only have, right? The upside is just you haven't built any of that cushion or levers into that plan. Sandra, Greg, any additional commentary to add on that?
So one of the comments in the Q&A was "no margin, no mission," which was, I thought, the quote that you were going to mention. I heard it as "no money, no mission." A nonprofit is such a misnomer because nonprofits have to make a profit, and it's very hard to make a profit if you don't budget to make a profit. Without profits, we don't build reserves. We don't build capacity to grow, and we're just setting ourselves up for failure.
All right. Can you hear me?
Yep.
Yes.
Yeah. You never know. Yeah, I think the point of nonprofits are businesses, right? Just because you're a nonprofit organization doesn't mean you're not an operating business, and doesn't mean you shouldn't have reserves, right? Eric said it really nicely, that it's a tax status. It's not a business model.
Mm-hmm. So good. Thank you guys for clarifying that, because talk about myths. I'm also getting a lot of feedback in the Q&A about not seeing the poll questions. So it's always a good best practice just to refresh your web browser when that happens. There still will be 2 more polls. So we are going to advance here. But we're kind of spread open, and I did get some good responses in the Q&A for the other. But it seems like most people, it's really just, meeting the message with different needs of different stakeholders. All right, Eric, I'll pass it back to you.
Yeah, so speaking of stakeholders, we'll talk a little bit more detail about charity watchdogs specifically. There's more than just these that are out there. These are, if you'll pardon the pun, the top dogs that potential donors or inquiring readers will find if you're out doing a Google search or asking an AI model to pull that for you, as is the way of 2025. I will say, of these 4, GuideStar is a little bit different than the others. GuideStar takes a different approach. It's not rating or evaluating organizations. Instead, it's focusing on transparency and sharing of information. And so they offer seals of transparency. They start at bronze, they go up to platinum. The more information you share, the higher a seal you get. So it's nothing, there's no rating of the information of what you're sharing. It's just, are you sharing it? The others do have essentially a scoring or star rating methodology. Each one has their own unique criteria. There's a lot kind of ins and outs and mechanisms within those. As I mentioned, overhead's commonly a thread across those, but exactly how and where that plays out and how it's weighted is different across each of those platforms. If you want a deeper dive on that, or if you just want to hear me talk more, we did a webinar on that last year, and the recording is available on our website. But there are statistics that say these ratings matter. Donors want to give to organizations they feel they can trust, and the data shared about your organization on these platforms has an impact in that perception of trust. On GuideStar alone, their platform is getting accessed by 10 million people a year. That's donors, that's leaders, grant makers, people in government, in research, academia, and journalists, all tapping into that information. Another survey put out said almost 3/4 of United States households gave to some charitable organization in the past year, half of those giving at least $101. And then the independent sector also had a survey that recently showed a little less than 2/3 of respondents would increase their trust in a nonprofit if it was committed to a set of guidelines and ethical principles for its operations. So this perception of trust, trust-based donor, the numbers are kind of speaking to that. There was also in give.org put out a 2024 donor trust report, kind of spoke to the flip side of this, with about 1/3 of respondents saying as a donor they would be detracted from giving if they weren't sure about where those funds were going to be spent or what the charity would do with the funds that were given. Just to further link that kind of from the theory of how this ties into giving, there's a very real connection between these charity rating profiles and access to donors. A lot of these apps, websites like Network for Good, Benevity, Facebook giving tools are tapping into information either from GuideStar or one of these other sources. So it really is one way to drive information and accessibility to those potential donors that are out there looking at this information, just by maintaining an active profile on these platforms. Some of these platforms too, like Charity Navigator, has a giving basket. So it's kind of like a shopping cart. In fact, it has a shopping cart icon where anyone who is using that website and searching, they're able to add stuff to their cart and make a donation based on what they're seeing. So it's not all doom and gloom and judgment out there. There really is potential funding on the other side of this platforms and tools that are out there. So what can we do? What practical steps can be taken as it relates to these charity profile ratings? The first place to start is actually with that 990. This drives so much of the foundational information that goes into these platforms. It's where they're sourcing a lot of the numbers for their calculations or just making the 990 itself available for people to pull and review. And that document, it's big, it's long, it goes way beyond just financial reporting. It includes program accomplishments, it includes questions about governance and policy. So you really want to make sure that the information you're putting in there isn't just true and correct, but especially on that program service accomplishments, that you speak to the true scope and impact of your organization's programming, because it's right there alongside the dollar amount for the spend. And so that's one way to really bake the context right into the numbers that go along with it. Now, you don't really have too much wiggle room with the overhead on that, but it does show that. That's where we have this kind of grid-based reporting. What was in the programs, what was in fundraising, what was in management in general. And so also just starting with the 990 really means wind all the way back to that cost allocation process that Sandra dove into earlier, because how we put those costs, I saw someone in the chat use the phrase peanut buttering. And I had a client that used that too, because you're spreading the costs like peanut butter across the bread of your financials. But how you put those costs into those buckets then informs how they show up in your accounting system. And that's how it comes out in your financial reporting for the Form 990. So if you're managing that at the point of kind of origination with the allocation, you can catch that upstream and manage it in a little more real time, instead of getting to the end of the year and seeing where the numbers fell and it being a little too late to do anything about it, other than trying to get a little maybe too creative with your accounting. From there, I'd say step 2 is look at that GuideStar Platinum seal of transparency. Again, this is just a place for you to share increasing levels of information to get those progressively higher seals of transparency. It tops out at Platinum. This might take a few hours, half a day, maybe a day, if you have all of that information available. And it does include non-financial, like programmatic and impact information at those higher tiers. But it's a way to demonstrate that your organization is being intentionally transparent, right? I think Greg said it's not just being compliantly transparent, but owning this, right, and kind of leaning into it. If nothing else, at least start with bronze. It's pretty basic information as far as claiming a profile and like making sure contact information is updated. So it's like maybe 15 minutes, half an hour just to get that first step. And then from there, supplement your storytelling, right? We have the annual report, but we can have more frequent touch points than that through the use of your website and social media. This is where you have the most flexibility to really tell your organization's story and quickly, easily, bite-sized, frequently reinforce those key accomplishments, those outcomes, that messaging that you want to be intentional, right? These are supporting the mission, even if it's not direct conduct of the program, whatever your kind of catchphrase is going to be for this. This is where you're able to drip that information out and have that communication steadily throughout the year rather than once a year through a Form 990 or an audit or an annual report. And with that, I think we've got another poll question.
We sure do. Are you leveraging social media to share your program wins? Just as Eric mentioned, it is a very useful tool and probably one of the most accessible to all of us right now. So it, to me, seems like an amazing opportunity to share that information. And just as responses are coming into the poll, if you've experienced any issues with responding to previous polls, we do apologize for those technical difficulties. As always, yeah, a refresh of the web browser is always a best practice. But if that doesn't work, know that after today's session, you can reach out to cpe@yptc.com in order to still receive credit for being here. So we want you to get your CPE still. And we really appreciate your engagement. And then to that point, know that there will be a recording of this session sent out automatically to the email that you registered with. So all of that will become already available to you. And since we're just about there, I will proceed. And it looks like the majority of people are leveraging social media. So that's a great thing. Glad to hear it. And obviously there's many people who still would like to more, but yeah, take advantage of that. Even if it's, one post a week, getting on a consistent basis of sharing your story can be really, really impactful because you never know who you're going to touch and impact. All right, so in our last section of today's session, we're going to look at overhead as a strategic asset and really combine all of the concepts that we've talked about so far and drive home why and how we believe overhead should be leveraged to its full advantage. So Greg, please take us away.
Yeah, and again, we're trying to change this mindset that overhead is bad. And we shouldn't have overhead, or there's a right percentage of overhead or wrong percentage of overhead. This is what we're trying to dispel. I think the most influential voice, or at least the most influential voice to me on this subject, has been Dan Pallotta, who wrote the book Uncharitable back in 2008. And he followed up with the book in 2013, I think it was, with a TED Talk. And that opened the eyes of many outside of the nonprofit community, or even within the nonprofit community, which is now something that we refer to as the overhead myth. And right after that, these charity watchdogs that Eric just spoke about, they actually came out with an overhead myth letter. And in that letter, they finally acknowledged that overhead alone is a poor measure of a charity's performance, that overhead costs are an important investment that charities make to improve their work. And they urge the public to pay attention to other factors besides overhead, like transparency, performance, leadership, and impact. And so this is about 12 years old now, but still this myth exists. So more work needs to be done. Recently, 2 years ago, Uncharitable was made into a movie that it took parts of the book, it took parts of the TED Talk. It was actually directed by Stephen Jones, the father of some famous actors that you may know. And it's so vital to this discussion that we're having. In Uncharitable, and I'm going to quote Dan Pallotta from it, he said, "Our generation does not want our epitaph to read, 'We kept charity overhead low.' We want it to read, 'We changed the world.'" So it's shifting this, our narratives, the story that we tell, not about how much overhead we had or we didn't have. It's about what did we do? What did we accomplish? Now, Uncharitable is required reading at your part-time controller. And if you've not read it or seen the movie or seen the TED Talk, I highly encourage you to do so. To me, it's more than a book or a TED Talk or a movie. It's a call to action. And the issue is that, as quoting Dan again, everybody wants charities to spend as little as possible on overhead. And that's backwards. Overhead is what drives growth. If charities can't grow, then they can't solve the problems. So overhead is a good thing. And the call to action that we really want to happen is, again, a quote from his book: the next time you are looking at a charity, don't ask about the rate of their overhead. Ask about the scale of their dreams. So it's up to us, all of us, to change the focus, move the eye of the reader, away from overhead and onto impact, onto what was accomplished or what we want to accomplish.
Thank you, Greg. So here's our next panel discussion, and I'm curious for Greg and Sandra and Eric, how do you recommend your clients talk about overhead with their board or leadership team as a growth strategy?
Yeah, it is vital to growth. As we talked about, overhead is what we need to be sustainable. And be more than sustainable. If you think about the definition of sustainable, that means to survive. And we just can't survive. We need to thrive now and in the future. So overhead is one of the most key components of that. It's a key component in a 3 or 5 year plan. And growth plans. That's building for the future. Overhead is the foundation that the house needs to be built upon. And if we don't have a strong foundation, the house will not survive.
Yeah, I agree with that. Can you hear me?
Yes, but it is a little metallic sounding, interestingly enough.
Goodness gracious. I feel like I am being punked today, but we're going to push through if we can.
Maybe give it just a second, Sandra. The sound is kind of striking. So Eric, perhaps, could you answer please, and then we'll come back to Sandra, see if it's improved.
Yeah,
thanks.
I'd probably come at this question from the angle of how do we start the conversation, and I think sharing the uncharitable book or the TED Talk or the movie is a good way to introduce the concept, right? And then maybe backstop that with someone from your finance team talking through, here's what overhead looks like at our organization, and knowing how you're allocating that and being able to explain it to the level of detail that's appropriate, not get too in the weeds and walk them through your spreadsheet and show them all of the math that we're very proud of as accountants, but at least functionally talk through, here's what we're doing and why we're doing. That could be part of a board retreat, or it could be part of your onboarding process, onboarding curriculum. I know even here in North Texas, there's an organization that has rights to do showings of the documentary, and so that's an option. You might have an organization nearby that does showings of the movie as well. So I know asking a board to read an entire book might be too much, but the TED Talk is maybe 20, 30 minutes. The movie is, I think, closer to the hour and a half mark. But starting these conversations helps you get comfortable information, and then it can equip those individuals with the knowledge that they need to carry it into their conversations to help shift perspectives on a broader scale.
Mm-hmm. Sandra, could I just test your audio? Let's see if it's coming through better.
Sure. Can you hear me now?
Yeah, okay. It still has the same issue, so we will move forward. But all right, we have our last poll question for today's session, and we want to know how confident, after hearing all of the expert advice from Greg and Sandra and Eric, how confident do you feel explaining overhead as a strategic investment? Has your confidence improved? Or perhaps do you still need some more tools and examples to be able to talk through this? And obviously it's not going to be a one-time thing, right? Even watching a TED Talk at one time, it's more of a starting a conversation and opening up a dialogue about these things and about reframing how it can be perceived, especially because, and I'm seeing this very clearly in in the Q&A is people have very strong opinions about this topic and how it exactly relates to the money being spent by these organizations, which are, doing the world's good. And so it's very interesting and very complex, but bringing it back to what Eric shared earlier is like, there's no need to make it more complicated than it needs to be. And we can really just go one step at a time, starting with today's session. So I will go ahead and move forward. And
Carly, it's a shame that Sandra's mic isn't working, because she was going to give the answer to what the exact amount of overhead is supposed to be.
Well, I guess the world will never know. Well, it makes me happy to see that so many of us feel at least a little bit of confidence around explaining this. And for those of us that need more tools and example, feel free to subscribe to our webinars. And every month we have a different topic that we're talking about on nonprofit finance and accounting. So that brings us to our final discussion point. And I got a great question earlier on in the chat about this is really how can we work together as a sector, as leaders in this sector, to redefine what efficiency really means here and push back at the demonization of overhead collectively.
Yeah, and to sort of reiterate what I was saying before, it is definitely shifting the focus from the numbers to the story and the story of impact. I mentioned earlier about a pie chart in our annual report, and as we were preparing for this discussion, Eric, I just love what you said. It's like if an organization is only providing a pie chart of their functional expenses in their annual report, it's a waste of paper. So we control the narrative, and it's up to us to deliver that narrative, not by numbers, but by words and sharing all that we accomplished.
Yeah, that context is so critically important. I mean, I like the expression, you can't manage what you don't measure. So it's important to know your own overhead rate and keep eyes on it so that it's within your expectations from how you're running the organization. But that also puts you in a really good position to know, how did that number end up being that number? So then you can share that context. The number alone is not it, right? And so just knowing what else went into that, knowing how that links to impact. Did you spend more on volunteer recruitment and doubled the size of a volunteer program? Volunteers don't show up in the financials, but the costs to get them does, and it's overhead. So just knowing what's driving that and how these things are coming together, and then putting that out there proactively to the extent that, it's reasonable and an appropriate level of detail, but knowing that story, owning the narrative around that, and just being frank that, we had to do more grant reporting this year, and that came with increased demands on our accounting function. Being able to speak to that and still bring it back home to, this is in support of the mission, and here's how that links back to our programmatic accomplishments, and we couldn't have done that without these thoughtful use of funds on the back office or the other side of the house of the organization.
Mm-hmm. Sandra, I'd love to test just one more time, because I really would like to hear your perspective. Yeah, not really. Bummer. All right. Well, regardless, I'm so grateful to have you with us, as Greg and Eric. Some really amazing key takeaways. And I know we covered a lot of ground in today's session. We were not able to get to all of the 181 questions that came through during today's session, but we're so grateful for your engagement and for your thoughts. That's helpful for us in developing future content and understanding your challenges and needs and perspectives even better. So we have our key takeaways here, as well as some helpful links included in the slides as well. So a lot of the links and references that we talked about throughout today's session are included here. So that really wraps us up. Thank you again for your time. Thank you to our awesome presenters. And we hope you have an amazing rest of your day and week.